Now here we get to talk about Asia, and we're going to kick off with China. So here when we look at what is some of the Chinese data that has come out, we've seen some of the aggregate financing new yuan loans increasing, but that's in line with what we expected because, again, they've been trying to increase some support. So we should see new loans, but we want to look at where is it versus historics, and we do have some of those charts to really look at and show what some of the problems are and the inability of getting it to where it needs to go. And I think that's the biggest piece because obviously M0, M1, M2, but more M2 has grown where M1 has remained actually declined versus estimates, which again is trying to marry and increase availability of funds while not increasing too much and trying to manage that liquidity conundrum that they're currently in. Now, FDI, so foreign direct investment, dipped versus April. It was 20.5%, came in at 17.3%, and we do expect that to continue to trend lower, especially as yields go up elsewhere, again, pulling some of that investment from China as we do have some of that money being reinvested and invested in other Asian nations, especially along the ASEAN. Industrial production was expected to be at negative 0.9, came in at positive 0.7. That's not surprising given that there was that bump in just manufacturing activity waking up from COVID. You're starting to see some areas getting slapped on the wrist and called out for withholding and impacting the supply chain. So they are starting to get a bit more concerned on the economy. So that's why I'm not surprised to see that. But retail sales was expected to be negative 7.1, came in at negative 6.7. You did have a holiday in there, so you did get a little bit of that bump, but you can still see that retail sales are still deeply negative. And an underlying problem when you consider Chinese growth, especially when we start looking at fixed assets. Rural year to date was expected at 6%. A growth of 6% came in at 6.2. Property investment still negative, slightly better, but then residential property sales got worse. Not surprising given where we were on the lockup, the lockdowns. So residential property sales should get better, but it's not going to get much better given that investments are still negative as we continue to see new home prices coming down a bit better than April, but again, still negative. So when we start looking at Chinese PPI, the estimate was for 6.4%, came in at 6.4%, but CPI remains sticky. And so you're seeing some of the PPI come down. That should continue in terms of some of the factory gate prices, but it's only going to come down so far, and we expect it to start to flatline as it approaches about 5.55%, given where, they're getting commodities as well as where they are taking in semi-finished goods to create the finished product. We're starting to see really some of that start to migrate. But then when you look at the consumer is still sitting there and feeling some of that pain. So then when you look at Chinese core CPI, you get a kind of an idea of why. And it's important to appreciate that all of this is happening with housing rental price. So when you look at the US in terms of OER, which is owner equivalent rent, so rent and home prices have gone parabolic. So that has pulled up inflation. But when you look at China, home prices and rental prices have come down, yet CPI is still elevated. So that's where even though you get a tailwind on inflation, or I should say a headwind on inflation, you're making it up based on pressure in other areas. So then when you think about stimulus and trying to really drive investment, you have to think about how the CCP has said we need to invest in infrastructure, which they've been talking about nonstop and have done, but you've starting to see the negative impacts because you're not getting the yield that you were hoping for, again, impacting some of this activity. So where are the major sources of Chinese infrastructure investment? And I think it's important to look at that financing from local governments is 30%. Net local government special purpose bonds is 19%. So 49% is already is being done by the local government, which is seeing tax revenue come down, which is seeing more rebates, which is seeing less employment, which is and then having to pay out more. So again, All of these things are impacting local finances, but yet they're being told to invest more in these infrastructure projects, which again is falling by the wayside because they don't even cover principal, let alone interest, which is why we've seen so much hesitancy. So now it's important to think about, well, when we think about household budgets, 20%, food accounts for 20% of it. So housing is 23%. So housing price, like rents are coming down. So all of these other pieces have to be increasing more than housing is coming down to see inflation where it is. And a lot of that is being driven by food, which is why the government, every time they talk about something, there's always talk about farmland, fertilizers, supporting the farmer, because they're so panicked about availability of food and how they can try to get this through, which is why the central bank, the central government has fired the first shot to correct overzealous COVID restrictions in terms of excess COVID restrictions, blocking truckers, slowing logistics. This is hitting the industrial side, but also the food side, because people, well, again, what China wants is control. If people are fed, it's easier to maintain control because there's not a impetus to rebel or to get angry. If I'm fed, I have a home, okay, I'll survive. But as soon as you don't have food, and your family is starving, your kid is crying because their belly hurts because they're not fed, that's when you're going to start to drive action, which is why there's such a focal point on food in China. And if you want to think about it, food equates to control, because if I can withhold how much you eat, how much you drink, what are you willing to submit to ensure you have enough? So the state council clarified what's allowed and what's not. All localities should lift travel restrictions for trucks from low-risk areas. Nucleic acid test results should be recognized nationwide. Local policies severely impact logistics, causing shortages in the supply of goods as well as food. Central government is consumed with worry about the economy. At some point, local officials will have to choose between restricting movements and controlling the virus. The bet is they prioritize controlling COVID because that is still the focal point. So yes, they're starting to call people out, but controlling COVID is still the most CCP oriented, and people and local officials want to align themselves with the CCP. So COVID will continue to be the main issue. And this is the biggest reason, again, why we remain so concerned on the macro outlook, not only just in China, but what that means for the global economy. So then when we start looking at more downside risks, so Chinese exports to the EU are coming down when you think about what the euro area is showing. And we have to look at Chinese exports and why it's so important, because remember, exports is what saved their economy last year. And this is just showing that when you think about the European area and the leading indicators and the US and the leading indicators, there is a steep drop down in terms of where this product is going, which is why the last kind of bastion of strength in terms of GDP growth is now being pulled away, which is why there's such a concern on how do they prop things up and start to kind of rejuvenate the growth, given consumers still weak, youth unemployment is over 18%. Manufacturing is slowing around the world, which again is going to draw down some of their exports, creating these pressure points. So Chinese industrial production had that bounce as it did at the beginning of 2020. We just don't see the bounce being as prominent to the back to normal. Because when you look through the end of 2021, so the second half of 2021 was already seeing a downward move. Now, this was pre-COVID outbreak in China. The pressure was already there. We saw it in new export orders. We saw it in new orders in general, which is why we see that downward pressure is more than just their local lockdowns. This is bigger than them. This is bigger than the lockdowns. This is a global problem, which is going to be their headwind with Chinese retail sales. So the local consumer is not going to save them because, again, looking pre-COVID, 2021, retail sales were already rolling over. And as we showed in 2019, which is why we were getting bearish in the end of 2019 for a lot of reasons, but the retail sales were already starting to diminish. And you can see that if you follow that trend, the trend was already coming down, and we see that as being a long-term problem. Now, mobility is increasing, but when you look at the road mobility index, it still remains under some pressure points as we go through, just because, again, people don't have the money. Their unemployment is still high. They're not looking to go out and travel. Now, when we look at monthly new loans, here you can see that it is back up above where we were, but it's better to look at the aggregate side, because when you look at aggregates, you can see that things are still fairly in line with 2021. And the goal is to try to outpace 2021 and get and pull forward some of those SPB, those special purpose bonds. But the supply was never the problem. It's demand. And we don't see that changing anytime soon, which is why when you look at China aggregate financing, so this is slightly different, you're below 2020. So you're above 2021. So you're pulling some of that forward, but you're still below 2020. And that's where the goal is to try to walk the line between not as high as 2020, but more than 2021. And this is another reason why we're so concerned about the leverage ratios, because as banks are incentivized and forced, and local governments are forced to do more, while you get a contraction in collateral value, that's only going to make the local, the leverage ratios that much worse. So then when we turn and look at those values, well, China new home prices year over year, negative 8%, but demand for housing is dwindling with a smaller labor force. So as we've been talking about, there is a global population problem, but it's very much weighted in certain areas, China being one of them, which is why when you look at the long-term trajectory in terms of shrinking population, pressure is going to continue to come not only on just the housing side, which is going to be a big headwind for value, but also on retail sales, which were already soft and already problematic. So this is looking at retail sales, and here you can see 2019 flatlining. It was not following the trend, which is why common prosperity and local the dual circulation strategy is so pivotal, because they need to replace that. And you're seeing just how bad and the pressure on retail sales really is. What will be the implications of China's common prosperity policies? So labor compensation is supposed to go up, but it's going to pull down operating profits. So as you're starting to see operating profits come down, China is going to try to shake as many trees as possible. So Bloomberg put out a story that the securities regulators recently summoned foreign bank executives to a meeting and warned them about their salaries. So you're trying to incentivize more investment. You're trying to pull in more foreign direct investment, but now you're coming at banks, which would attract that capital, because would you rather invest through a JP Morgan in China and a Goldman Sachs in China, or a local Chinese bank? But now they're coming after executives. Executives in attendance, which include Credit Suisse's local chairman and Goldman Sachs, were told to keep compensation in line with the common prosperity agenda. Then at a press conference, the agency labeled the report fake news and denied the meeting ever took place. So again, you're starting to get, because they know how this looks. And as they start to try to wake up their economy, this is you are already seeing people hesitant to invest in debt, local and foreign Chinese debt, and this is not going to help. So when you think about the CSRC did call in foreign executives to brief them on the new guidelines and warn them against excessive incentives. The executives interpreted this as the CSRC intervening in determining their pay. So overall, the event illustrates just how jittery and how scared businesses are in China's ever-changing regulatory environment as pressure mounts on the economy. Because typically when the economy starts to fall under pressure, especially in a communist regime, you have two options. And Deng chose one and Xi is choosing another. In Deng's view, he said, let some get rich. So they became less communist. And if you look at the USSR, when the USSR started to break down, instead of getting less communist, they got more communist, and that created and accelerated the cracks. So Xi is following Mao's trajectory and getting more communist and trying to counter some of this, which again is going to shun foreign investments, which is going to create this skittishness that again is going to just increase the headwinds that the local economy is going to face. And that's why when you start looking at foreign listings continue to dwindle, and that's becoming a much bigger problem in terms of China accessing foreign cash. Well, now that is happening all the while China's foreign defense minister gave a speech, and what his speech had, Taiwan is part of China and national reunification will definitely become a reality. Let me make this clear. If anyone dares to split Taiwan out of China, we will not hesitate to fight. We will fight at all costs. We will fight to the very end. This is the only choice for China. So you have a concern on foreign direct investment, the concern on salaries, a concern on exports to your largest entities. Again, you're seeing this pressure, which is why we don't see China having this big bounce and this big resumption in terms of where things are, but instead way more pressure. And India continues to be on that trajectory. So industrial production was up better than estimates in April, expected to be at 5%, came in at 7.1%. But the leading indicators, as we talked about in May and June, have that coming back down on the back of inflation. So inflation came in a bit better than estimates, was expected to be at 7.1, came in at 7.04%, but that's still a massive number. And the leading indicators show there's more to come as wholesale prices went up. It was expected to be at 15.3%, came in at 15.88%. So again, you're seeing those pressure coming through. And imports had a big spike as exports also slowed down a bit. But import prices were massive. And that's where you're starting to see more of this pressure coming through in May, which again is going to weigh on just what that industrial production looks like and why we see way more pressure in India. And so China, I think people are waking up to the struggles that they're going to have and the problems. We think India is one of the ones that is going to have a much bigger slowdown as well, and bigger because I don't think the market is expecting it yet or has priced it in yet. So this is just showing the industrial production bounce. We do expect this to come down and fall below 2019 levels, while India wholesale prices continue to move up. But when you look at, again, wholesale prices, leading indicator into the price target, so it dropped in May a small amount, but it's still well above the top end of the target of 6%. And you get an idea of just how broad the increases are in terms of food and beverage, clothing, fuel and lighting, housing. All of these things continue to be this driving force, and we don't see that accelerate. We see not so much that the inflation is going to accelerate, but there's a lot of staying power above 7%, which, as we said, is very much our base case. Oil is not solely responsible for India's widening trade deficit. It is a lot of things, and it's the trade balance ex oil, gems, and jewelry is growing because all things are increasing, especially food. India's external position is deteriorating rapidly when you think about current account balance, primary income, goods. A lot of these things, which is why the deficit is growing in India, and the cost of filling that deficit is getting more and more expensive. And that's why we think that there's going to be a cut to a lot of subsidies, and you're going to start to see a bit of that austerity as they try to balance the budget, because they're not going to be able to afford to issue new debt while also rolling old debt, given how expensive it is. And the Fed raising rates 75 basis points with another 50 to 75 on the table is going to make that even more problematic when we look at investments. So the India merchant trade balance, again, when going back to 2002, it's the worst ever. And here's a lot of those reasons why, with the inflation, food and beverage, cereals, again, when you look at vegetable oils, accelerating again, all of this remaining up. And then core inflation dropped sharply due to a high base. So it's important to think about inflation eased. It was still above 7%, and that's with a sharp drop in pricing because of a high base. So you get an idea that against a high base, it's still accelerating, which is why we think that India has a lot of problems, and it's more along the lines of the local consumer, and they're going to try to export as much of that as possible, but they will find it difficult given everybody's in that pressure, which is why we do see some of those import prices getting worse for the U.S., because we're going to import a lot of this inflation, which they're going to try to export. Now, Japan producer price index was expected to be at 10%, came in at 9.1. So again, still elevated, still problematic, and we don't see that changing. And again, that's going to be something that we're going to import when we look at some of these key pieces. So industrial production in Japan was negative. We see that continuing to be the case in May. Machine orders, though, remain strong. So we expect industrial production to come down, but we do expect core machine orders to remain fairly stable given that we still have a decent amount of investment that was made, but we are seeing a drop in new export orders. So as these orders are filled, we expect new orders to slow down and that accelerating problem to increase. Imports were expected at 44%, came in at 48.9. Exports were expected at 16.1, came in at 15.8. So you're starting to see imports increased a bit. Exports dropped a bit. We expect that to remain kind of the case at this point until we start to get new orders dropping. Then imports will slow. Exports will start to curb over. And again, more pressure on the horizon. And now finishing up with South Korea, you can see that I want to talk more about the export price. So export index. So the export price index last month was 1%, came in at 3.1%. Index year over year was expected, it came in at 21.4% last month, came in at 23.5%. Now that is a huge problem because again, we import that. So that is going to come into so yes, and as we talked about in segments 2 and 3, U.S. import prices came down, but this is showing that they're about to go back up or at least stay elevated as we go forward because we will import this and there's staying power there because the import price index for South Korea, it exploded. Last month was negative 0.9, came in at positive 3.6%. That puts the year on year, which was last month 35 to 36.3. So again, their imports are accelerating. That's going to hit local consumption and again, provide that supporting base to export prices, which is going to be disseminated and distributed into and support that global inflation backdrop. So that's what we have for you today. If you have any questions, again, you can find us on Twitter or in the comments section. We hope this was helpful. We enjoy doing it. If you have any questions, again, I know we covered a lot. I know some of it's very complicated, and we try to simplify it, put our, what the data means, what it means going forward. So we do appreciate you sticking with us and watching. Thanks again. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.